Many Americans recently noticed bigger Social Security payments hitting their bank accounts, but not everyone realized there could be a tax catch. After the passage of a major new law, some recipients also received one-time back payments for benefits they were previously denied. While the extra money is welcome, it can affect your taxes because increasing your total income might make a portion of your Social Security benefits taxable. Fortunately, there are special tax rules and strategies that can sometimes reduce the impact. Understanding these details can help retirees avoid unexpected surprises when filing their 2025 tax return. Welcome back to Seniors Relief. This channel is here to keep you one step ahead, not catching up late. I break down the latest Social Security updates, SSA payment changes, SNAP and EBT benefits, IRS announcements, stimulus news, and government programs in simple words, so you clearly understand what affects your money. Many people only hear about these changes after the deadline passes or payments are missed. But viewers here know early and know exactly what to do. So subscribe now, stay informed, and make sure you're always among the first to hear about new payments, benefit increases, and eligibility changes that could put money in your pocket. The law responsible for these changes is the Social Security Fairness Act, signed on January 5, 2025. This legislation eliminated two outdated rules known as the Windfall Elimination Provision, WEP, and the Government Pension Offset, GPO, which had long reduced Social Security benefits for certain workers. These rules affected over 2.8 million people, primarily those who earned pensions from jobs that did not pay Social Security taxes, such as teachers, firefighters, police officers, and some federal employees. The removal of these provisions was a significant win for public servants who had been financially penalized for decades. Importantly, the Social Security Fairness Act was made retroactive to January 2024, meaning eligible individuals could receive additional payments covering missed benefits from that time. The Social Security Administration, SSA, began recalculating and correcting benefits starting February 25, 2025. Most recipients saw higher monthly payments beginning in April 2025, and these adjustments continued through July 2025. In total, the SSA issued more than 3.1 million payments, with a combined value of approximately $17 billion. This included not only the higher monthly benefits, but also one-time retroactive lump sum payments to cover the period from January 2024 until the new rates took effect. On average, these lump sum payments were about $6,700 per person, though amounts varied depending on each recipient's earnings history and prior benefit reductions. While this extra money provides a welcome boost to retirees, it is important to remember that Social Security benefits remain taxable under federal law. Up to 85% of benefits can still be subject to income tax, depending on your total combined income, which includes adjusted gross income, non-taxable interest, and half of your Social Security benefits. The SSA will provide Form SSA 1099 in January 2026, showing the total benefits received in 2025. This form is also shared with the IRS, ensuring that all payments are accounted for when calculating taxes. For individuals, the tax brackets on Social Security benefits are structured as follows. If combined income is below $25,000, benefits are not taxable. Between $25,000 and $34,000, up to 50% may be taxable, and above $34,000, up to 85% of benefits could be taxed. Married couples filing jointly have slightly higher thresholds. Below $32,000, no tax applies. Between $32,000 and $44,000, up to 50% may be taxable, and above $44,000, up to 85% of benefits may be subject to tax. These brackets mean that a large retroactive lump sum could push some retirees into higher taxable ranges, leading to bigger than expected federal tax bills. In addition, higher income in a single year may increase Medicare premium surcharges, IRMA, for certain retirees, further impacting finances. Fortunately, there is an option called the lump sum election that can help minimize taxes on these one-time payments. This tax rule allows recipients to calculate the tax on their retroactive Social Security benefits using their previous year's income, 2024, rather than treating the entire lump sum as 2025 income. To use this option, taxpayers must check the box on line 6C of Form 1040 or 1040 SR. The IRS provides worksheets in Publication 915 to determine whether this election would save money. Importantly, this method does not require filing an amended tax return for the previous year, making it a relatively simple and effective tool for reducing tax liability on retroactive benefits. There is also a new temporary deduction that could further ease the tax burden for seniors. Passed as part of the One Big Beautiful Bill Act in July 2025, this provision allows a deduction of up to $6,000 for individuals and $12,000 for married couples filing jointly for those aged 65 and older. This deduction is effective from 2025 through 2028 and gradually phases out for higher income earners. Single filers above $75,000 and couples above $150,000 see a reduction in the deduction. While it does not directly affect Social Security taxes, it can reduce overall federal tax owed, helping seniors keep more of their benefits. It is also important to remember that state taxes on Social Security vary widely. Some states tax Social Security income fully or partially, while others do not. People who anticipate higher taxes due to lump sum payments can adjust withholding using Form W-4V or make estimated tax payments to avoid penalties. Careful planning and awareness of these rules can prevent unexpected surprises and ensure that retirees retain as much of their hard-earned Social Security benefits as possible. Ultimately, while the larger Social Security payments and retroactive lump sums are a financial boon for millions, understanding the tax implications is crucial. By using options like the lump sum election, taking advantage of senior deductions, and planning for state taxes, retirees can maximize the benefit of these historic changes without facing an unwelcome tax shock. For many recipients, the sudden arrival of both higher monthly benefits and a retroactive lump sum can feel like a windfall, but it's important to treat this money strategically. Using it wisely can make a big difference in long-term financial security. Some retirees may choose to pay down high-interest debt, boost emergency savings, or even invest a portion to generate additional income. Others might use part of the payment to cover overdue medical bills or home improvements that had been delayed. Planning now can prevent the lump sum from being fully absorbed by taxes or unplanned spending, turning it into a meaningful financial boost rather than a temporary spike in income. It's also worth noting that timing plays a crucial role in tax strategy. Since the lump sum payments count as 2025 income, even a moderate increase in monthly benefits could combine with the retroactive payment to push recipients into a higher tax bracket for the year. For those already near the thresholds for Social Security taxation or Medicare surcharges, proactive planning is essential. Retirees can work with a tax professional to determine whether adjusting withholding, making estimated payments, or using the lump sum election could minimize the overall tax impact. Ignoring these details could result in an unexpectedly large tax bill the following spring. Beyond federal taxes, retirees should consider how this income interacts with other government programs and benefits. Higher reported income could affect eligibility for need-based assistance programs, subsidies, or even certain Medicaid benefits in some states. While Social Security itself is not means-tested, the increase in reported income can have ripple effects on other areas of financial planning. Understanding the full picture ensures that receiving extra Social Security money does not inadvertently reduce other forms of financial support or create complications down the line. Finally, staying informed and organized is key. The SSA and IRS provide multiple notices, forms, and publications explaining benefits and tax responsibilities, but it can be easy to overlook details. Keeping track of Form SSA 1099, understanding the options in Publication 915, and reviewing any relevant state tax guidelines can save retirees a great deal of stress. Being proactive rather than reactive allows individuals to make the most of the Social Security Fairness Act's historic changes while minimizing surprises. With careful planning, these enhanced benefits can truly strengthen financial security and provide peace of mind for years to come.